continue and start with AS 26. Shall we begin? Okay. AS 26, intangibles. So what are intangibles? They are assets which are non-monetary in nature, without physical existence or physical substance, and they are held for use in production or supply of goods or services or for administrative purposes. So same assets definition, the only point is that they are without physical substance. So what AS 26 is going to cover? Expenses pertaining to deferred revenue like advertisement, training expenses, research and development expenses, licensing, patents, copyrights, such expenses are going to be covered. So here we are going to see how or what is an intangible, recognition, how to measure the intangible, measurement, and how to record the same in the books of the accounts in the future period, so carrying cost, etc., and what will be the disclosure. So this is a complete standard which speaks right from recognition, measurement, presentation and disclosure with respect to AS 26, sorry, with respect to intangibles. First rule, what is the rule of recognition? The intangibles shall be recognized in the books if there is a certainty of future economic benefits and if the cost can be measured reliably. So 2 points. There should be a certainty that it will give future economic benefits. Second, the cost should be identifiable. Okay, even if one of the two criteria is not satisfied, it will not qualify under a intangible asset. Now, for research and development alone, one point of emphasis is required. Now, what is research phase? Research phase is where we do not know what is the end use. We do not know whether we are going to get a success rate or not, which means economic benefits is not certain. So, in research phase, economic benefits is not certain. Therefore, expenses relating to research cannot be capitalized. Expenses relating to research will never be capitalized. But what will be capitalized? Once research is completed, once the product is established as a success, then further development activities for that product, which means creating a prototype, creating marketing strategies, creating production strategy, all that will come under your development plan, which is your development phase. So that will be classified under your intangibles, and because there is a certainty of future economic benefit, provided there is market viability for that product. It is not enough if your product is successful. Your product should have an active market. If the product is successful but does not have an active market, again there is no future economic benefits. Therefore, the product will be expensed and it will not be capitalized. Okay. So for research and development alone, please remember, research phase not capitalized. Development phase capitalized only if there is a market viability established. Okay, so these are the major points to remember with the recognition rule. Now coming to cost. So now when we speak about recognition, what should be the price or the cost at which it should be recorded in the books? When the asset is self-generated, what do we mean by self-generated assets? Assets which are developed internally without any consideration being paid. Okay, without any consideration being paid or without any expenses being incurred directly, then they are called as self-generated assets. Classic example is self-generated goodwill, which will not be having a cost. So the cost of self-generated asset is nil. So that is why self-generated goodwill will not be recorded in the books. Cost of intangibles shall include purchase cost, which is purchase rate for any licenses, etc. Development expenses, any expenses directly related to the construction or development of intangibles, like employee cost associated with development. Okay, then rent associated with the place where the development activities are taking. Expenses incidental to the development or construction of intangibles. So incidental is Any items required for the purpose of the development, if you are buying any items, then they are incidental expenses. Whereas cost excludes selling expenses and packaging. So basically marketing and distribution expenses and other expenses which are not relevant to the development, which means they are which are not directly related or which cannot be attributable to the development phase. Okay, so these are the costs that will be considered for the purpose of intangibles. Carrying cost. So okay, before that, if you look at the cost, it will be similar to what we see in property, plant and equipment. Same rule down. All directly related costs, purchase, taxes, etc. will be included. If it is refundable taxes, if it is selling distribution expenses, non-related costs, then it will be excluded. So same rule of asset classification, just that here it is intangibles. Okay. Carrying cost. The carrying cost is nothing but the cost at which it will be shown in the books of accounts. So in the books of accounts, intangible has to be amortized over straight line unless you find any other suitable method. Say if I know the expenses can be amortized over sales, then sales proportion can be taken, or expenses can be amortized over number of units produced. Say if it is patents or copyrights, number of books produced or number of books materials produced, then that can be used. If you have a basis, you can use that systematic basis. However, if that basis is not available, then we have to uniformly amortize it over the useful life. And if the if the scenario is silent, or if practically you are not able to identify the useful life, the maximum useful life for an intangible that is presumed by the standard is 10 years maximum. Okay, so you cannot generally beyond 10 years, you will not be amortizing an intangible. Standard presumes 10 years as the maximum life of an intangible. Please make a note. Now suppose in the future I am recording the asset I have provided for depreciation. Now later I am adding some cost. So there is a cost increase in the value of the intangible. Or I feel that the useful life has to be reduced, say from 7 years to 4 to 4 years. If I want to reduce the useful life, then same rule like depreciation. The revised impact will be calculated prospectively, which means from the date of change, whatever is the book value as on the date of change, from that we will calculate the revised amortization. Same ditto like property, plant and equipment standard only. So the change will be taken prospectively. And suppose if any year there is no future economic benefits or viability, which means in 3 years you have been recognizing an intangible. Now suddenly in the end of the 3 years you realize that there is no more market viability for this product or for this intangible. Then the remaining book value or the remaining carrying cost will be fully written off from the books of accounts. Okay. So first thing, when an intangible will be recognized, when there is certainty of economic benefits and when the cost can be identified. Research not recognized, development expenses recognized. Cost will include purchase cost, development costs, taxes, okay, and whatever is directly attributable. Whereas cost will exclude any selling, distribution and other unrelated expenses. In the books we need to amortize it over a systematic period or use over a uniform period. Maximum period prescribed is 10 years. If there is a change in the useful life or change in the cost, the impact is going to be revised prospectively. And suppose in 1 year in the later, if you find that the market viability is not there, the entire asset will be written off. Simple 5 rules for the standard, and this is your AS26 for reference. Right? Any doubts in the standard? Okay. So shall we move on to the practical question? Question number 8. PQR Limited has acquired a brand from another company for 100 lakhs. So it is a brand that is purchased. It contains that the brand is very popular and famous. No amortization can be provided. Is it agreeable? No. As per AS 26, amortization has to be provided for intangibles over a uniform period. And the standard assumes that the maximum prescribed rate of useful life is 10 years. Okay. So I've also given you the answer in detail. You can look into the PDF for your reference. But the 2 points that you have to remember here is this: you cannot stay without charging amortization, which means it has to be amortized over the useful life. Maximum useful life that can be considered is 10 years. Right? Can we move on to the next? Next. X Limited is engaged in the business of newspaper and radio broadcasting. It operates through different brand names. During the year ended 31st March, it incurred a substantial amount on business communication and branding expenses by participation in various CSR initiatives. The company expects to benefit by this expenditure by attracting new customers over a period of time, and it has capitalized brand development expenses and intends to amortize the same over a period in which the benefits are expected to flow. As the accountant of the company, do you concur? You are required to explain in line with the provisions. Can the business development expenses be recognized as an intangible? Yes. Okay. Because there is certainty of future economic benefits. Second, what is the period maximum useful life that it can be recognized? 10 years. அதே ரெண்டு பாயிண்ட் தான். Okay? Yes. Okay? Now here, one more point that you can add for value addition in your answer is, it is certain that future economic benefits will flow. Second, the cost of the activity has to be identified reliably. Okay, because they have mentioned that it is participating in various initiatives. So probably the cost it might be difficult for it to identify the cost. So that point also, if you write, it will add a value to your answer. So 3 points here we will write. Point number 1, future economic benefits. Point number 2, the cost has to be measured and identified reliably. And third, the cost has to be amortized over a maximum useful life of 10 years. Any doubts in the question? C. A company is showing an intangible asset at 88 lakhs as on 1/4/2021. The asset was acquired for 120 lakhs. On 1/4/17, the same is available for use from that date. The company has been following an amortization of intangible assets over a period of 15 years. Comment on the accounting treatment. Can I have 15 years accounting treatment? No. We can only have a maximum period of 10 years. So therefore, considering a period of 10 years, can you calculate the revised depreciation or revised amortization? Prospective. Answer. Are you getting 14.6? Okay, so how did you calculate? We have how many years left? 6 years left. Correct? If the 6 years are left, Now 6 years we are going to take it for a carrying cost of 88 lakhs. Okay, so 88 by 6 you would have got the value of 14.6, which is the revised amortization, which is wrong. Here the cost is not changing. They are not changing the useful life. They have adopted a wrong useful life. It is a change in the treatment itself, or it is a change in the policy itself, which means they have adopted a wrong accounting practice. And when the accounting practice has to be corrected, you have to correct it from beginning of the year. Bold, italics, underline. Please underline and write. Here the error, here the accounting treatment is wrong. Therefore, the correction needs to be made from the beginning of the acquisition period. Not kind of retrospective. Yeah. What we will commonly think is year change. But year change, suppose if they say the intangible was over a period of 8 years, now management decides to reduce it by 5 years. Appo you are right, because it is still within the limit of 10 years. Then 8 to 5 they are reducing. Now whatever is the remaining book value, directly we can calculate. But here the management has done a mistake which you are correcting. Okay, so now how to calculate? Okay, as per, so let me do the calculation, please check. As per correct treatment, correct accounting treatment. Okay, totally how many what is the total value of intangibles? 120 divided by 10 years. I should have charged a depreciation an amortization of 12 per year. So carrying cost will be, how many years have lapsed? I think it is purchased in 17, correct? So 18, 19, 20, 21. 4 years have lapsed. So carrying cost will be 120 minus 12 into 4, which is 48, which gives us the answer as 72 lakhs is the carrying cost, which should have been the correct carrying cost. But what is the wrong carrying cost? Wrong carrying cost is 88 lakhs. Okay, I am using the word wrong, etc. for your understanding. Okay, you can write carrying cost as per the company, carrying cost as per AS 26. Like that, if you write, it will look better in your answer paper. So 88 lakhs. Now, what will happen to this difference? This is an error committed in the past. So this will be adjusted along with the general reserve or opening reserves. Error in the past adjusted along with the previous year reserves. So difference of 18 minus 72, which is 16 lakhs, will be adjusted with general reserve or opening reserves, whichever is available. Opening P&L, whatever is available. Similar. Not exactly. Yes. Actually, a prior period item only, but accounting treatment slightly is. Okay. Right. So now what happens here? What will be the opening carrying cost? Now the opening carrying cost will be 72 lakhs. The revised or the correct amortization will be 12 lakhs in the given case. Okay. When you will do the prospective effect that we generally do, normally how we calculate prospective effect, when you will do is when the period given is less than the 10-year limit. Okay, so if they say that The original period was 6 years or 7 years. Management now decides that it wants to amortize over 2 years. Like that, if they are changing, then you can go by whatever is the carrying cost as on that date divided by remaining useful life. Am I clear? Friends online, I hope I am clear with this. Any doubts? Okay. So remember to check whether the estimates given is as per the standard before you conclude the answer. Right. Question number 9. Surgical Limited is developing a new production process of surgical equipment. During the financial year ended, the total expenditure incurred was 67 lakhs. The production process met the criteria for intangible on 1st January. Expenditure till 1st January was 35 lakhs. Further, expenditure incurred on the process for the financial year ended 31st March is 105 lakhs. Okay. The recoverable amount of the technique embodied in the process is estimated to be 89 lakhs. This includes estimate of future cash flows and outflows and inflows. Under the provisions of AS 26, you are required to ascertain, number 1, expenditure to be charged for March 2020, carrying amount as on 31st March, expenditure for 2021, carrying amount as on 2021. So 2 years they are asking you the P&L and balance sheet impact. Okay. Let us first answer the first question. Expenditure to be charged in P&L and what amount to be taken to intangible. Now in 2020, the total expense was 67 lakhs, whereas till the moment it met the criteria till the 1st of January, it was 35 lakhs, which means for 35 lakhs, there is no future economic benefits. After 1st January only, there is certainty of future economic benefits. So therefore, amount to be recognized as intangible will be 67 minus 35, which will be 32 lakhs. And the amount to be taken to P&L will be 35 lakhs, which is this amount. So part 1 of the answer, expenditure to be taken to P&L account, 35 lakhs is recognized as the expense. And part 2 also you have answered. As per AS 26, what will be the cost of intangible? As on the year ended 31st March 2020, 67 minus 35, 32 lakhs will be the value of intangible. First 2 subdivisions clear? Third subdivision. Expenditure in P&L for 31st March 2021. So for the next financial year, how much is the total expense incurred? 105 lakhs. So now 105 lakhs is incurred after it met the criteria of intangible. So which means ideally I can recognize the entire amount as expense. However, I should also look at whether there is a future recovery or future economic benefit. So the carrying amount opening balance is 32 lakhs. Add expenses during the year 105 lakhs. So total amount that can be recognized is 137 lakhs. However, the recoverable amount from the intangible is only 89 lakhs, which means you can only expect an future economic benefits amounting to 89 lakhs as on 31st March. Okay, which means the value of that intangible as on 31st March is only 89 lakhs. So book value is 137 lakhs, whereas the recoverable value is only 89 lakhs. Therefore, the difference will be treated as loss, because that amount is the amount for which future economic benefits is not available, write off. So the amount to be written off is 137 minus 89. No, 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 no. No, no. Your 32 is the total cost plus 105. So total book value is 32 plus 105 minus what is recoverable. Basic logic of cost minus recoverable value. Yes. Say the third scenario. Okay. So I am repeating the third adjustment. Please listen again. The total expense incurred is for 105 lakhs. The asset is already meeting the criteria of intangible, which means for 32 lakhs opening balance, I can add another 105 lakhs as expenses. So I can change the carrying cost of the intangible as 32 plus 105, which means I will get a book value of 137. If the nothing else was mentioned, your book value is 137 closed. So your depreciation will be revised for 137. But here they are saying the recoverable amount of the technique is only 89 lakhs, which means the present value of future economic benefits is only 89 lakhs. So now I know the asset value is in the books is 137 lakhs, against which I have only a recovery available of 89 lakhs. So I will recognize the difference as loss. So the loss to be taken will be 137 minus 89, which is 48 lakhs. So if loss is 48 lakhs, what will become the carrying cost of the asset now? 137 minus 48, the amount of 89 will be shown in the balance sheet as intangible. Okay. So carrying amount in the balance sheet will be 137 minus 48, which is your recoverable amount 89. For 2021. 2 financial years. Till 32 lakhs is for 2020. Further, 105 lakhs has been incurred for 2021. So total expense incurred available 32, of which only 89, 87, 89 is recoverable. Okay. Is the question clear? Question number 10. The company acquired for its internal use a software as on 1/3/2020 from UK for 1,50,000 pounds. Pounds. Yes, yes. The exchange rate as on that rate was 100. The seller allowed a discount at 2.5%. Other expenses were import duty 10%, additional import duty 5%, entry tax recoverable later. So which means input tax benefit is available for entry tax. Installation expenses 150. This is rupees. Installation expenses is in rupees. Okay. And professional fees for clearance from customs is in rupees. Compute the cost of software to be capitalized. Go ahead. Please do the calculation. Remember, first convert it into rupees from pounds. Then add and subtract whatever is relevant. $74 lakhs. Okay, let's check. 875. Okay. So let's check the answer. Purchase cost 150 pounds. Okay. You can directly multiply and then subtract trade discount, or you can subtract the trade discount and then multiply into rupees. Anyways, you will get the same answer. So here I'm subtracting the trade discount. Minus 2.5% trade discount, 3,750 pounds, which gives me a total value of 146,250 pounds. Now converting into rupees, you get 1 crore 46 lakhs 75, sorry, 25,000. Add import duty 10% on 146.25. Add additional import duty at 5%. Now additional import duty is not on the basic price, it is on the price including the import duty. When the word additional is there, it is like a cess. It is tax on tax. Okay, so remember, when the words are additional, when the word is cess, all this will be tax on tax. Okay, so additional import duty is on 160,87,500. Entry tax 2% recoverable from the tax department, which means credit is available for that entry tax. The amount is recoverable, therefore it shall not be included as a part of cost. Okay, so entry tax ignored. Add installation expenses 1,50,000. Add professional fees for customs clearance 50,000. Therefore, your total cost to be capitalized 170,91,875 rupees. Okay. 170,91,875 rupees. Your past as papers and RTPs. Okay. So clear with AS 26? Any doubts in the standard? If any, you can quickly run through and ask. I think the AC is off. Can you please switch it on? Remote anga irka. Is the AC remote there? Please switch it on. Right. So shall we move on to the next standard? Another simple standard. AS 29. Provisions, contingent liabilities and contingent assets. Theoretically simple, practically complicated, but for us theory is what we are going to do. Okay. So current bit on. So we are in this standard, we are going to be discussing three terms: provisions, contingent liability, contingent assets. If we are clear with these three terms, the standard is done. Okay. First thing, provision. What is a provision? A provision is a liability. Listen here. A provision is a liability measured using a substantial degree of estimation, which means where there is a liability, which means you know there is a liability. However, the amount of liability cannot be estimated. The amount is not actually available. So in that case, a provision is created. What is that liability? That liability is a present obligation. So here the word that you need to catch is present obligation. So present obligation means as on today I have an obligation to pay. I just don't know what is the amount. So there is an obligation to pay arising out of past events, the settlement of which is expected to result in outflow of resources of the enterprise. So which means you have a present obligation, and because of that obligation you are going to pay out some money, which means there is an economic outflow. So in provision, what is the rule to remember? There is a present obligation. It results in economic outflow, but we are not certain about the amount. The amount cannot be measured with certainty. So only if these 3 points, present obligation, outflow and estimation, these 3 points are available or criteria is met, provision shall be recognized in the books. Suppose I know that there is a present obligation, but I am not able to estimate the value. I don't know what will be the value. In that case, can I recognize it as a provision? No. So only if the criteria, all the 3 points in the criteria are met, it can be recognized as a provision under AS 29. Second, contingent liability. Now, contingent liability, the obligation itself is not present today. The obligation is a possible obligation or a future obligation. So here the keyword is a possible obligation arising from past events. Okay. The obligation will be confirmed only by occurrence or non-occurrence of future events which is uncertain. So the obligation is not present, the obligation is futuristic. How the obligation will be determined? By the occurrence or non-occurrence of some future activity which we do not know, which is uncertain. Or suppose if the obligation is present, a present obligation, not recognized as it is not probable to result in an economic outflow. So I know that there is an obligation, but I know I will not have to pay out money for that. Or I don't know the value for it. For example, now a new law is being created. Now in that new law, I have to pay more tax. So I know that a new law is going to be created. I know the present obligation, but I do not know what is going to be the tax impact, how much tax I need to pay, what is the actual value impact. So then it does not come under the criteria of provision, it comes under the criteria of a contingent liability, right? So for contingent liability, two rules: a possible obligation where the obligation will be crystallized only when the future event occurs or does not occur, or a present obligation where there is no probable outflow or the amount is uncertain. So in simple words, if something is not a provision, it will come under contingent liability. Advance tax is accounted. It is neither provision nor contingent. It is directly accounted in the books. Obligation, amount is also paid. Provision, if I'm going to call provision for tax, that is why we call it as a provision, where the amount is uncertain, but there is a present obligation. Okay. Yeah. So basically, advance tax is all going to come under this category in the year end called as provision for taxation. You're going to adjust it and find out provision for taxation. So it boils down to the same rule, provisions. Okay. A contingent liability is not recognized in the books, which means it is not provided for in the books, but it is disclosed in the financial statements. A provision is recognized, contingent liability is disclosed. Last, contingent asset. It is a possible asset, which means future asset, that the existence of the asset will be confirmed only by occurrence or non-occurrence of future economic events, which is not certain. Now, contingent asset, can it be recognized? Definitely no. Can it be disclosed? That is also no, because a contingent asset shall never enter into your books even in the form of disclosure. Okay, a contingent asset shall not be recognized nor disclosed. Only if the asset crystallizes or there is an actual recovery, the asset will be recognized in the books. Okay, three rules, three terms. If you are clear with these three terms, AS 29 is done. Go through. Shall we start with the practical questions? Question number 11. Chaos Limited is in the process of finalizing its accounts for the year ended 31st March 2020. It seeks your advice in the following cases. Chaos Limited has filed a court case in 1415 against its competitors. So, past event. It became evident to the lawyers in the year ended that the company may lose the case and pay 3 lakhs being the cost of litigation. First question, is it a past obligation or is it a present obligation or a possible obligation? It is a present obligation because it is more or less certain that there will be a loss. Okay, it is a present obligation. Second, what is the amount estimated or is the amount actual crystallized? The amount is estimated. Probably they have to pay 3 lakhs, more or less. Okay, so in this case, what will be the answer? The answer is, since it is a event out of a present obligation and since the estimate is reliably available, it will be recognized as a provision in the books. It is a present obligation. Amount can be reliably estimated. Depends on the how the verdicts are. Generally, long pending cases are all contingent. And it is a management call. So beyond a point, you cannot interfere in the management call or the professional discretion of the lawyer or judgment of the lawyer. Point number 2 or question number 2. A new regulation has been passed in 1920 by the Healthcare Ministry to upgrade the facilities. Deadline set by the government is 31/3/21. The company expects 10 lakhs for the upgrade. Answer. Provision. Okay. Let's read the answer. Under the new regulation, an entity is required to upgrade the facilities by 31/3. However, as on 31st March, there is no obligation, okay, either for the cost or for the fines and regulations, because here the deadline is set in the future. Just because a deadline is set in the future doesn't mean an obligation is immediately created. When an obligation is created depends on when the activity is started by the enterprise. Suppose if the deadline is 31/3, I still don't do it after 31st March 2021 also. Government will charge me fine. For the fine only the obligation is created, not for the expenditure. Correct? So government asks you to pay tax, income tax on due date. Just because government is asking us to pay, நம்ம போய் முதலே pay பண்ணிடுவோமா? We will wait. Which means obligation is freezed only when you are going to pay the tax. Or obligation is created only when the tax becomes payable from your end or tax is recognized in your books. Correct? Suppose you say that I am not going to pay tax right now. Okay. In that case, obligation will be created, but the amount is going to be paid later. Okay. Now, in this case, the government is saying from next year onwards, you have to pay tax at 25%. Just because government is saying from next year onwards, does your obligation start from today? No. Next year's calculation is next year's obligation. So, in the same rule here, the law is created doesn't mean the obligation is immediately arising, because here the law is not for a payment, the law is for some expenditure of assets. So which means only when the expenditure is actually incurred, the obligation will be created. So here no provision will be recognized. Ideally, what should we show this as? A contingent liability. Okay. Third, the company gives 1 year warranty for its healthcare equipment under the contract of sale, that it will make good any manufacturing defect by repair or replacement. So it is giving a warranty replacement. As per past experience, it is probable that 1% of such cases and estimated cost of repair or replacement is 10% of the sale value. So sales is 5 crores. So by past experience, it knows that on an average, 1% cases will come for repairs, and of that 1%, I have to incur a warranty cost of 10% of the selling price. So 5 crores, what is 1%? 5 lakhs. Of that 5 lakhs, 10% will be the warranty cost. 50,000. So which means the probable expense is going to be 50,000. Is it a present obligation or a probable obligation? If you answer this word, then your answer is finished. The question in AS 29, you should only answer this word. Present obligation, probable obligation. Warranty is always present immediately from the date of sale. From the date you sell the product, warranty is eligible for the customer, which means from the date of sale, there is an obligation for warranty. So there is a present obligation, but the amount is estimated. Therefore, it shall be recognized as a provision. What is the amount that will be recognized? 5 crores into 1% into 10%. I'm reading the answer again. The obligating event is the sale of the healthcare equipment with warranty, which gives rise to a legal obligation. Therefore, there is an outflow which is probable. Hence, provision has to be recognized at the best estimate of costs. Value of provision, 5 crore into 1% is the cost of sales, of which 10% is the cost of repair. Therefore, 50,000. So in AS 29, the crux is about present obligation or probable obligation. If you are finding out the answer to that, then automatically your answer will get finalized. Okay. Any doubts in question number 11? Is the question clear? Question 12. An oil company has been contaminating land for several years. Okay. It does not clean up because there is no legislation requiring cleanup. 31st March, it is virtually certain that a law requiring cleanup of land already contaminated will be enacted shortly after the year end. Is provisioning required? They are saying that in the future there is going to be a law that is going to come up which will mandate the cleaning process. Probable obligation. Therefore, is provisioning required? No. Since the obligation is not present as on 31st of March, provisioning need not be created. And you can stop your answer with that. Okay. You can go through the answer. This is your suggested answer. Okay. But like I said, pick up the keywords. Right. Okay. See, we all know it is difficult for us to replicate the suggested answers as it is. So no, never think, see, if you have to write it as it is, and don't attempt to try memorizing how the suggested answers are, which is very difficult for us to do. What we can do is understand how keywords are presented. And generally, a small tip that I will give you for theory answers, write it in passive voice. Active passive voice. When we write it in passive voice, instead of saying that, the company should do this. As per the provisions, this particular act is not valid by the company or shall not be done by the company or something like that. If you write, simple tip, but it will make your answer look more professional. Okay. Basically, because I will also tell you the reason, because we are all having the laws derived from UK, and UK laws are all generally UK or the language will all be passive voice mostly. US follows more of active voice style. whereas UK follows passive voice. So namakku vandu the law related ah எழுதுறது எல்லாமே கொஞ்சம் passive voice la மாத்தி எழுதினாலே our answers will feel more professional. நீங்க ஒரு answer you can for your practice also you can try one writing in a normal English active voice language and write it in this passive voice style. You will clearly find a contrast, and trust me, this trick works. I myself have done that trick in the exams. Once again, what will be the answer if fines are imposed? Okay, in question number 11, she is asking what will be the answer for question number 11 too, if fines are imposed. Even if fines are imposed, from the date of imposition of fine only the obligation is present. Till then there is no obligation. Am I clear? Okay, so this summarizes AS 29. Moving on to the last standard under group 2, AS 18. Of course, I'm not taking AS 14 because it's covered separately. AS 18, related party transactions. Again, this is an out and out disclosure related standard. It is going to say you can do whatever transactions you want, do whatever related party transactions that the company is generally do, just disclose. As simple as that. Okay, we have other laws to control what should be the related party transactions, etc. But standard is very simple: disclose the related party transactions. So who are related parties under AS 18? 5 points. First, enterprises that are controlled or in common control of the reporting entity. When I say controlled or common control, we will have holding subsidiaries, common subsidiaries, or fellow subsidiaries, subsidiary of subsidiary, everyone will come into this picture. But the point that you have to remember is, when we say control or common control, we look at this term called substantial interest. And for all practical purposes, substantial interest is taken as 20% of the ownership. Be it share capital or voting rights, whatever it is, 20% of the ownership directly or indirectly, which means holding along with the subsidiary. If it is having 20% in another company, then that becomes a related party. Okay. Associates and joint ventures. Associates, anyways, the rule is 20% ownership. Joint ventures are temporary special purpose vehicles which are formed between the entities. Third, individuals. So first two is about enterprises. Third is about individual. Individuals directly or indirectly owning interest, having interest in voting power. So it can be directors who have decision making authority. Directors who have substantial interest, like more than 20% of the shares. Okay, or any key managerial personnel who has the ultimate decision making authority in that in the entity or company. So individuals directly or indirectly owning an interest. Fourth, key managerial personnel or relatives of such personnel. Fifth, an enterprise which is significantly influenced by key managerial personnel or relatives or persons having interest. So if I am a director in company X and if I am also a director in company Y, X and Y can be related only if I have controlling authority in X as well as in Y. I should have controlling significant influence in company X as well as in company Y. Only then X and Y can become related. Just because I am a common director need not be the fact that the two companies are related. The question is here about significant influence or substantial interest. So 5 points. First two are enterprise controls. Third and fourth are relating to individuals. Okay. Parties not deemed to be related. So where AS 18 will not apply even if there looks to be a relationship. Two companies having common directors. So the scenario that we just discussed, unless the director is capable of affecting the policies of both the companies, which means unless he has significant influence, the two companies need not be related. Sole sellers, sole customers, sole distributors. If you are a monopoly, you will be the only seller for certain products. Okay. So for all companies, you need not become a related party. Suppose if you have only one customer in India or one customer for your entire business, okay, sometimes I will produce and I'll manufacture and give it only to one company. Just because I am giving it only to one company does not make the decision making influential. Okay, so sole selling, sole customer, sole distribution is not related party under AS 18. Financing institutions, government authorities, trade unions are not covered under AS 18 relationship. So what is to be disclosed under AS 18? The nature of relationship. What is the nature and amount of transactions happened during the period, like purchase, sales, income, expense, and what is the balance as on the reporting date? Is it receivable balance, payable balance, if you have any asset or liability? So that needs to be disclosed. So 3 items to be disclosed under AS 18. Yes, ma'am. What is called deemed related? Two companies have a common address. If has a one company has a same. Other if he does not have, no, they are not related. So if one, even in if in two companies, if the director does not have a voting power in even one of the companies or does not have a say in one of the companies, then also they will not be deemed to be related. In both places, if he has significant influence, only then they can be related. Okay. What will happen is, practically in Companies Act, what will happen is, if the director is a related party, he will be excluded from voting there. He has to declare and say that this is a matter of my interest because I am a director there, therefore I will not be taken, you don't take me for voting. That is a specific provision under Companies Act for board meetings. So naturally that interest is getting eliminated. Practice all that arm's length transaction, what should be the correct value of transaction, nothing is defined under AS 18. That goes to respective laws. Company law will take care, income tax law will take care. Okay, so AS 18 only disclosure. Question number 13. In respect of a key supplier who is dependent on the company for its existence and the company enjoys significant influence over the price of this supplier, which may not be formally demonstrable. Okay. Can the supplier and the company be treated as related parties? The company is having a sole customer relationship or a sole distributor relationship. There is only one key supplier who is defining the transactions of the company. But just because he is the only key supplier does not mean that the two entities are related. So it comes under not deemed to be related under AS 18. Next, define key management personnel. So who are key management personnel? Who are KMPs? Company secretary. Okay. In Companies Act, KMP definition is there, but AS is not going to speak that. AS says directors or managing directors or anyone who can influence the decision making of the enterprise. Simple statement, because here we are not speaking only about companies. We are speaking about sole proprietorship, partnership, everything. So either directors, whole time or managing directors, or any person who has the decision making authority in the enterprise. In case of company, director, whole time director, or in case of other entities, any person in whose directions the enterprise operates. But practical purposes, naturally, if there are such people, they will come under the definition of KMP if it is a company. If it is partnership, partners will be the people. If it is sole proprietor, there is only one person. So that is how practically it operates. But in your answer, you have to define for both companies and non-companies. 14. Kushi Limited entered into an agreement with Mr. Happy for running a business for a fixed amount payable to the latter every year, not later. Okay. Okay. The contract states that day-to-day management of the business will be handled by Mr. Happy, while all financial and operating decisions are taken by the board. So only day-to-day operations Mr. Happy is going to handle. Mr. Happy does not have any voting power in Kushi Limited. So no voting power, no decision making. So is he a related party? No, because he does not have the decision making authority, neither does he have the voting power. Mere carrying on of activities or management of business activities does not make him a key managerial person. Second subdivision, Sri Banu, a relative of a key management personnel, received a remuneration for 3,50,000 for his services in the company for the period from 1st April to 30th June. So 3 months he has served in the company, for which he has received 3,50,000. On 1st July he left the service. Is he a related party as on 31st March? Yes. During the year, if any person is associated with the entity under that 5 category during the year, not at the end of the year. Okay, so the word is related party. If the key managerial personnel is associated with the enterprise during the year, then he shall be covered under the definition of related parties under AS 18. Okay. For the previous year disclosure, we will consider 2 years kaprama we will ignore, because in financials we have to disclose current year, previous year values. Yes. So remember, I will write this word also here, during the year. Okay. So if he is a, now this also brings me to the question that he was asking. So thanks for bringing up. So if a person is a related party in the current year, next year he is not a related party, will I still disclose? Yes. Okay. 1 year related, 1 year not related also I should disclose, because in financial statements we will give 2 years comparative figures. If a person is not a related party in the current year, next year he becomes a related party. So will I disclose him in the next year financials as related party? Yes. Accordingly, previous year values also have to be disclosed. When disclosure is not required, for 2 consecutive years, if he ceases to be a related party, then disclosure is not required. Okay. So with this, we complete our major area of discussion, accounting standards, which is going to account for 30 marks, solid 30 marks of your paper. Okay. Do not skip any of the standard. Standard kammi da, adula nama choice odakudadu. Okay. Do not skip any standards. Because if it's all 5 mark question. So if you are skipping, you are leaving a small 5 mark, which will matter when you are looking at an aggregate score. Okay. Right. So next, the areas that we are going to discuss today are going to be ESOP, buyback, banking companies and non-banking financial institutions. Okay. Now let us start with the smallest area of discussion first, which is non-banking financial companies. Okay. And then we will, after lunch, we will go ahead with the balance topics. After NBFC. Your material for NBFCs for the second part. Let's skip. Material. இவ்வளோ கேள்வி கேட்குறீங்க. Shall we begin? Yes. I hope you've taken out the materials. Now, non-banking financial companies, as such, if you see, it is also as vast as banking, but from your syllabus perspective, we are restricting your syllabus. In your syllabus, it is restricted to certain topics. So those are the topics that we will be discussing in the class as well. There are three areas, okay, that can be tested from an NBFC. First, calculation of net owned funds. What is meant by net owned funds? Net owned funds is nothing but the net effective capital that the company is having. Okay, the capital effectively that is held by the company, apart from investment in related parties, subsidiaries, all that, excluding that, whatever is the net capital along with the reserves that the company is maintaining. So let's get into the formula. Owned funds is equal to paid up equity capital plus compulsorily convertible preference shares. Okay, remember, owned funds are from the perspective of equity holders. So only convertible preference shares can be taken for equity perspective, because for preference shares, they are otherwise non-forming part of equity. So paid up equity plus convertible preference plus securities premium plus any other free reserves. Okay, so these are all the reserves available. Plus one-time reserves like capital profits, capital reserves, but excluding revaluation reserve. Why? Because revaluation reserve is not collected in cash. It is only a book entry. So therefore, we will exclude it. Excluding revaluation reserve. Now, when you are adding profits, you need to subtract losses. So minus loss, minus intangible assets created, minus deferred revenue expenditure. So this is your net capital available, which is your, capital available, which is net owned funds. Owned funds. Now, what is the difference between owned fund and net owned fund is, owned fund is what is the company's funds available for equity shareholders. Whereas net owned funds is what is the company's funds available for equity, excluding related party transactions, or excluding this financial transactions to related parties like subsidiaries, other NBFCs. Okay, because there what happens, you brought in money for your business, but when you invest in subsidiary, you are taking money away out of the business. You are giving it to your subsidiary, which is that business. So here that will be excluded. So net owned fund formula again, owned fund minus investment in shares of group companies or other NBFCs, minus investment in debentures, bonds, loans, advances to group companies to the extent it exceeds 10% of the owned funds. Meaning, if your owned funds is 200 crores, your investment in shares and debentures in this NBFCs and group companies put together can be up to 10%, which is 20 crores. If it is 20 crores or less than 20 crores, no deduction. Direct or net owned funds is 200 crores, allowed, permissible limit. Whereas if the investment exceeds 20 crores, say if it is 35 crores, 200 crores is the owned funds, 35 crores is the investment. What is the excess? 15 crores is the excess over 10%. which will be subtracted for net owned funds. So 200 minus 15 will be the answer for net owned funds, which will give you 185. இருக்கக்கூடாது. இருந்ததுன்னா excess will be subtracted. 10% மேல இருக்கக்கூடாது. 20 is the amount that we discussed. 10%. Investment in shares, investment in debentures, bonds, because it is a non-banking financial company, if it gives loans, that will also be subtracted. To the related party NBFCs, then that will also be subtracted. Okay. So this is your net own funds and own funds calculation being tested in the past, at least in the last 2-3 attempts, for 5 marks. Okay. Optional. Ana vandhuduna 5 marks. Sure. Second. On the whole talk, NBFC is what, that is what I'm saying. So coming 1 minute, I'll. Okay, Vishwa should, if the limit is within 10%, then you need not subtract. Okay, I think he's asking if I should I subtract if it is less than 10%. You need not subtract, because RBI allows, nowadays RBI is governing NBFCs, right? So RBI allows up to 10% of investment in group entities. So if it is within 10%, you need not subtract for net owned funds calculation. Part 2 of the discussion, NPA norms, non-performing asset norms, and provision for non-performing assets. Now here you have to remember 2 types of NBFCs: systemically important NBFCs, systemically non-important NBFCs, or non-systemically important NBFCs. Both are deposit taking, non-deposit. What do you mean by deposit taking? Whether they can accept it or not, accept deposits or not. That is not the criteria for us. Systemically important is generally based on a criteria of capital and threshold, turnover criteria. So we need not remember that criteria. The question will clearly give us whether it is systemically important or not important. Okay, based on that, you should remember what is the provisioning norms. Remember, systemically important, they are larger NBFCs. Systemically non-important are the small NBFCs or small finance companies, etc. So for systemically important NBFCs, the criteria for non-performing asset is any overdue up to for more than 3 months. Same like banks. We'll come to banking companies separately. For systemically important, it is 3 months. Whereas for non-systemically important, relaxation is there. If it is a lease rental or hire purchase company, NPA is up to 12 months of overdues. Whereas if it is any other company, like a small finance company, gold auction company, for all that, the criteria is 6 months overdues. So remember, systemically important NPA criteria overdues is 3 months, whereas for non-systemically important, we have 2 limits. For lease and hire purchase, 12 months. For others, it is 6 months. Okay. So what are the provisioning norms? Provisioning norms is nothing but the provision for bad and doubtful debts that needs to be created on the assets, on the loans given. Okay, Harini, which part do you want me to repeat? I think Harini is asking some area to be repeated. Okay, I'm repeating the NPA norms. Okay, the time period, right? So I'm repeating the NPA norms. If it is systemically important, 3 months of overdue shall be considered. Please remain silent. 3 months of overdues shall be considered. If the overdues are more than 3 months, then it is classified as NPA. Whereas if it is non-systemically important, then if it is hire purchase or lease rental companies, like companies giving you goods on hire purchase or lease, then 12 months overdues I can wait. I can wait up to 12 months to collect the overdues. And if no dues are received within 12 months, then it will get classified as NPA. Whereas for other NBFCs, if no dues are received within 6 months, it will get classified as NPA. Important and not. it will be given in the question. So far, they have not asked you to find out whether it is systemically important or not important. Okay. Now, provisioning norms refers to the provision for bad and doubtful debts that is to be provided for the loans given by the NBFC. There are basically rather 4 classifications: standard assets, substandard assets. Substandard assets, so basically substandard assets all fall under this NPA category. So standard assets, substandard assets, doubtful assets and loss assets. For again, for provisioning norms, remember we have systemically important having a higher provision, slightly higher provision, and non-systemically important slightly lower provision. For standard assets, it is 0.40% of the loan value or outstanding value, not the loan value, outstanding value. Whereas non-systemically important 0.25%. இது ஒன்னு மட்டும் தான் change ஆகும் for systemically important and non-systemically important. All the other rates will remain the same for both the types of NBFCs. Substandard assets. What are substandard assets? An NPA within 12 months. NPA within 12 months, which means you have the time limit of 3 months or 6 months for classifying as NPA. After that classification of NPA, for first 12 months, it is called as substandard assets. Okay, NPA, or in other words, let me reword it like this: assets within 12 months overdue after becoming NPA. Assets within 12 months overdue after becoming NPA. Exactly, 3 plus 12. If it is systemically important, 3 plus 12, non-systemically, 6 plus 12. Or 12 plus 12, depending on the case. Substandard. So for NPA, secured, unsecured, everything is same. Only for banks, we have the differentiation. Secured, unsecured will be different. For NBFC, secured, unsecured is all same. For NBFC, whether it is secured advances or unsecured advances, rate is 10% flat. Okay. Next, doubtful. So what is doubtful? For doubtful assets is after becoming NPA, for 12 months you are waiting and calling it as substandard. So after the 12 months period has lapsed, which is basically that 3 months plus 12 months, or for non-systemically 6 months plus 12 months criteria. So after this 12 months has lapsed, the asset becomes a doubtful asset. So after lapse of 12 months from NPA date. Still, if I have not received any money, then it becomes a doubtful asset. And here we have the classification of unsecured doubtful assets and secured doubtful assets. For unsecured assets, 100% provision. For secured assets, you again have time slab up to 1 year, which means after this 12 months, again I will wait for 1 year. Provision is 20%. After 12 months, 1 to 3 years, provision is 30%. And greater than 3 years, 50%. Okay. Greater than 3 years, 50%. And what is a loss asset? A loss asset is those advances which are classified as written off by the enterprise or by the NBFC. Right? The management will say that I will never receive this money, write it off. Those are called as loss assets. Right? Loss assets 100% because it is fully written off. So clear with the timing and the provision percentage calculation. However, this provisioning calculation will be slightly different if it is going to be for hire purchase or lease assets, which is the third area of discussion. For hire purchase of leased or leased assets, what is the provisioning norms? The provisioning is based on the percentage of net book value. What is this net book value? Basically the amount of receivables that you have to get. Okay, or if you have given an asset on lease, so you will have lease rentals receivable, right? So that is what is your net book value. Now, how do we calculate the percentage of lease rentals? We again go by time period up to 12 months. Okay, no provisioning. So up to 12 months, why no provisioning? Because for NPA categorization, 12 months we have time. So no provisioning. 12 to 24 months, the moment it becomes an NPA, 10% of net book value. 24 to 36 months, 40% of net book value. 36 to 48, 70% of net book value. And more than 48, 100% of net book value. If it is after 12 months from the due date of last installment, here remember, in between if any installment is due, then we will go by this percentage. Suppose the totally you have to pay say 7 installments, and all 7 installments due date is over, then after 12 months from the payment of 7 installments, the entire amount should be written off as provision, irrespective of the fact that it is still falling under the criteria 12 to 24. That does not matter. Here last installment due date itself is over abdina, entire value has to be written off. Whereas for this table, it will not be the last installment due, it will be the middle installment, say second, third, fourth, like that some installment would have fallen due. Okay, so 3 areas of questioning: net owned funds, NPA recognition. So they might give you a question saying that this is overdue for this many days or this many months, whether it is standard, substandard or doubtful. Third area is provisioning. Under provisioning, we have one for the normal NBFCs, systemically important and non-systemically important, and for hire purchase or leased assets. Right? Practice questions. Question number 1. Let's quickly do the calculation. Okay. While calculate the net owned fund of an NBFC based on the following information. Paid up share capital 200 lakhs, free reserves 150 lakhs, compulsorily convertible preference shares 50 lakhs, revaluation reserve, is it included? No. Revaluation reserve not included. Securities premium 25 lakhs, intangibles 10 lakhs, and capital reserves 15 lakhs. Calculate owned fund. Yes, we subtracted that. 450. 450, yeah? 430. 200 plus 150 plus 50 plus securities premium 25 minus book value of intangibles 10 plus capital reserves 15. 4, how much? 430. Okay. 430 is your owned funds. Okay, let's. Okay, okay. Subtract. Did you subtract it? Total additions will be 440 minus 10 lakhs. So 430 lakhs will be your answer. Okay. Okay. While closing the account of its books for the year end, a non-banking finance company has the following advances. So they have given you the advances. Whenever they are asking you to calculate provision, you need to put a separate column to state the percentages. They also carry marks. So for writing the provision percentages, you have marks. So in a separate column, write the percentage, next calculate the value. Calculate the amount of provision as per the non-banking financial company, systemically important non-deposit taking company. So non-systemically important means for standard advances alone 0.25 percentage. Go ahead and do the calculations. Yeah. Okay. 3247. 10050. 1005. Ah, 3202. 3202. Right, right. My bad. It is non-systemically important. It is 0.25 percentage. So your provisions will be 315 for standard, 1005 for substandard, secured up to 1 year, then 20% 480, 1 to 3 years 202.5, and for more than 3 years 112.5. Unsecured portion fully written off 100% 727. Loss assets fully written off 360, giving you a final answer of 3202. NBFC will always be a simple question, don't worry. I hope the answers are clear. 3202. Friends, this chapter, these are all small cakewalk chapters I would call, because very easy for us to score, and especially mainly time consuming is less. For completing the answer, it is less time consuming. So these questions you can, within lesser time, you can complete more part of your paper in your exam. Question number 2. GEM Limited is an NBFC providing hire purchase solutions for acquiring consumer durables. Following information is extracted. You have paid up capital, compulsory convertible preference shares, free reserves, securities premium, capital reserve 319, out of which 220 lakhs alone is out of sale. So what will be the balance? The balance is assumed as revaluation, which need not be included. So we should only consider 220 lakhs. We should not consider 319 lakhs. Deferred revenue expenditure is given. Debentures, cash and bank balances, investments in debentures of subsidiaries, investments in shares of other NBFCs. Calculate owned fund and net owned fund. So first work out owned fund. No impact. No impact. It is only to confuse you. Gem Limited was again to 2021 question. Jana, June, July, but 20, not the previous attempt, I think before that. You should get an owned fund of 4020 lakhs. Okay. Now, listen carefully. Debenture issued, we are not worried about total debentures. Cash and bank balance is irrelevant. We need investment in debentures of subsidiaries and investment in shares of other NBFCs. So 171 plus 945, which gives us 1116. Now, what is 10 percentage of owned fund? 402 is 10 percentage of owned fund. So what is the excess? 1116 minus 402, which gives us 714. Therefore, net owned funds is 4020 minus this excess portion alone, which is 714. Out of which 10% is 402. Now, investment in group companies and other NBFC is 1116. 714. So, net owned funds is 4020 minus 714. Yeah. Yes, ma'am. Someone called me? Okay. Because the capital reserve generally can arise either out of sale or it can arise out of revaluation. So we are assuming the other part is revaluation, we are excluding it. So if they have explicitly given only out of sale, we consider only that portion. I hope question number 2A is clear. 2B, a hire purchase related question. Yeah, got it. Financiers Limited is an NBFC providing hire purchase solutions for consumer durables. You have the assets, you have the overdue period. So what is the percentages? Up to 12 months, nil. 12 to 24, 10. 24 to 36, 40. 36 to 48, 70, and more than 48, 100. And it is going to be on the net book value. What happens to the interest that is accrued? That interest will be reversed. So that interest will not be recognized in the books, but no provision or nothing required because you are going to reverse the entire amount of interest. Okay? Yeah. So you need to calculate provision out of the net book value. First one, 18,000 nil, then 10% 200, 40% 500, 70% 420, and 100% 150, giving 1270 as your provisioning made for the assets. Simple. Okay. So these are your frequently tested areas from NBFCs. With this, we complete this chapter, non-banking finance companies. Any doubts in the chapter? Simple, very scoring topic. Okay, these are small areas which I would suggest do not skip. It is all about remembering the percentages and remembering the numerical period thresholds. So you can remember them, which will help you score easily in your paper. Take your break for lunch. We will resume at 2 o'clock. and we will continue with the balance topics. We will start with ESOP, buyback, and then go to banking companies. Right? Take your break and we will resume at 2 p.m.